In the world of personal finance, your credit score is your financial reputation. It's a powerful number that can open doors to financial opportunities or slam them shut. Understanding your credit score and how it works is crucial for anyone looking to borrow money, secure favorable interest rates, or simply achieve financial stability. A credit score is essentially a numerical representation of your creditworthiness. This three-digit number ranges from 300 to 850 and is calculated based on the information in your credit report. The FICO score is the most commonly used credit scoring model in the United States. It ranges from 300 to 850 with distinct categories that reflect varying levels of creditworthiness. Understanding this range and where you fall within, it can help you gauge your financial standing and identify areas for improvement. Several key factors influence your credit score, and understanding them can help you manage and improve your score effectively. The major components that affect your FICO score include payment history, amounts owed, length of credit history, new credit, and credit mix. Payment history, which accounts for 35% of your score, is the most significant factor. Amounts owed, also known as credit utilization, accounts for 30% of your score. Length of credit history, making up 15% of your score, measures the age of your credit accounts. New credit, which accounts for 10% of your score, looks at how many new accounts you have opened recently. Finally, credit mix, also accounting for 10% of your score, considers the variety of credit accounts you have, such as credit cards, mortgages, and auto loans. To illustrate the impact of a credit score, consider two individuals, Sarah and John. Sarah has a credit score of 780, while John has a score of 620. Both apply for a $20,000 auto loan. Because of her higher credit score, Sarah qualifies for a 3% interest rate, while John gets a 7% rate. Over a 5-year loan term, Sarah will pay significantly less in interest compared to John, highlighting the financial advantages of a higher credit score. Employers, landlords, and insurance companies may also check your credit score as part of their decision-making process. While your credit score provides a quick snapshot of your creditworthiness, your credit report is the detailed document that underpins this score. It's a comprehensive record of your credit history, providing a detailed account of your borrowing and repayment behavior. Think of it as your financial resume, showcasing your financial responsibility to potential lenders. Credit reports are compiled and maintained by credit bureaus, which are companies that collect and organize credit information about individuals. The three major credit bureaus in the United States are Equifax, Experian, and TransUnion. Each bureau maintains its own database of credit information, and while there may be some overlap, your credit report can vary slightly from one bureau to another. Your credit report is divided into several sections, each providing specific information about your credit history. This section includes your name, address, social security number, and date of birth. This section details your open and closed credit accounts, including credit cards, retail accounts, installment loans like auto loans or student loans, and mortgages. This section includes information from public records that can affect your credit, such as bankruptcies, tax liens, and judgments. This section lists all the times your credit report has been accessed by lenders and other entities. Regularly reviewing your credit report is an essential aspect of managing your financial health. It allows you to catch any errors or inaccuracies that could be negatively impacting your score. It also helps you detect potential fraud and identity theft. Your payment history is the most influential factor in determining your credit score, accounting for a significant 35% of your FICO score. This means that consistently paying your bills on time is crucial for building and maintaining good credit. Late payments, missed payments, or even partial payments can all have a negative impact on your score. Credit utilization, a key factor making up 30% of your FICO score, refers to the ratio of credit you're currently using compared to your total available credit. It's calculated by dividing your total outstanding credit card balances by your total credit limits across all your cards. A lower credit utilization rate is generally considered more favorable, indicating that you're not overly reliant on credit and are managing your finances responsibly. Experts recommend keeping your credit utilization below 30% to maintain a healthy credit score. Ideally, aiming for a utilization rate below 10% can further boost your score and showcase excellent credit management. While having access to credit is essential for building a credit history, opening too many new credit accounts in a short period can actually harm your credit score. Each time you apply for credit, whether it's for a credit card, a loan, or even a store financing option, the lender typically makes a hard inquiry on your credit report. Hard inquiries can temporarily lower your credit score, especially if you have multiple inquiries within a short time frame. Section 4. The value of a seasoned credit history. The length of your credit history plays a significant role in determining your credit score, accounting for 15% of your FICO score. A longer credit history generally contributes to a higher credit score, as it demonstrates to lenders a consistent track record of managing credit responsibly over an extended period. Lenders view borrowers with longer credit histories as less risky, as they have a proven history of handling debt and making timely payments. One crucial aspect of building a long credit history is keeping your oldest credit accounts open even if you no longer use them frequently. Closing old accounts, especially your first credit card or loan, can shorten your credit history and potentially lower your score, even if you've managed those accounts responsibly. While it might be tempting to close unused accounts to avoid annual fees or simplify your finances, consider the long-term impact on your credit score. If you have an old credit card with no annual fee, consider keeping it open and making a small purchase on it occasionally to keep the account active. This demonstrates to credit bureaus that you're managing your credit responsibly over time. Building a lengthy credit history is a gradual process that requires patience and consistent effort. By keeping your oldest accounts open and managing all your credit accounts responsibly, you can gradually establish a strong track record of creditworthiness, which can then open doors to better financial opportunities in the future. Section 5. Maintaining a healthy credit mix. Having a diverse mix of credit accounts can positively impact your credit score, demonstrating to lenders your ability to manage different types of credit responsibly. While it's not necessary to have every type of credit account available, a healthy mix typically includes a combination of revolving credit, such as credit cards, and installment credit, like auto loans, student loans, or mortgages. Revolving credit involves a credit limit that you can borrow against and repay as needed, while installment credit involves borrowing a fixed amount of money and repaying it over a set period with fixed monthly payments. Having both types of credit on your report shows lenders that you can handle different repayment structures and manage various debt levels responsibly. However, it's crucial to avoid opening new accounts solely for the purpose of diversifying your credit mix, especially if you don't need the credit. Remember, Each credit application can trigger a hard inquiry, potentially lowering your score. Instead, focus on managing your existing accounts responsibly and only apply for new credit when you genuinely need it and can afford the payments. A healthy credit mix doesn't happen overnight. It's built gradually over time as you navigate your financial journey. By demonstrating responsible credit management across different types of accounts, you can further strengthen your credit worthiness and unlock access to better financial products and services. Section 1. The high cost of low credit. Your credit score acts as a gatekeeper, influencing your access to financial products and services. A high credit score unlocks lower interest rates and better loan terms. Conversely, a low credit score can lead to higher interest rates and financial challenges. Higher interest rates translate to a larger financial burden for borrowers. Building and maintaining good credit is crucial to avoid higher borrowing costs and unlock better financial opportunities. The ripple effect of credit scores. Credit scores impact loan approvals and interest rates, but their influence extends beyond borrowing. They affect various aspects of your financial life and opportunities. Landlords use credit checks for tenant screening. A low score can lead to higher deposits or rejections. Insurance companies consider credit scores for premiums. Employers might check your credit report for financial roles. Your credit score impacts many areas of life. Section 3. Building a foundation for financial wellness. Your credit score is more than just a number. It's a reflection of your financial habits and decisions over time. By understanding how credit scores work and the factors that influence them, you can take control of your financial well-being and build a solid foundation for a brighter financial future. Building good credit is an ongoing process that requires patience, discipline, and a commitment to responsible financial practices. It's about making conscious choices that demonstrate your credit worthiness to lenders and other entities that rely on your credit history. Start by establishing a solid track record of on-time payments. Set up automatic payments or reminders to ensure you never miss a due date. Keep your credit utilization low by managing your credit card balances responsibly and avoiding maxing out your cards. Limit new credit applications and only apply for credit when you genuinely need it and can afford the payments. Remember that improving your credit score takes time. There's no quick fix, and it's essential to be patient and persistent in your efforts. By consistently practicing responsible financial habits, you can gradually improve your credit worthiness, unlock better financial opportunities, and pave the way for greater financial security. Section 1. The importance of vigilance. Monitoring your credit reports and scores is essential for protecting your financial well-being. Regularly reviewing your credit reports helps catch errors and detect suspicious activity. Think of credit monitoring as a proactive security system for your financial identity. Just as you wouldn't leave your home unlocked, don't neglect your credit information. By regularly checking your credit reports, you can spot unauthorized access or activity. Monitoring your credit helps identify and address errors. Credit reporting isn't foolproof and mistakes can happen. A payment might be incorrectly reported as late, or an account might be listed twice. These errors can negatively impact your credit score. Another reason to monitor your credit is to detect potential fraud. Identity theft is a growing concern. By monitoring your credit reports, you can spot any suspicious activity. Early detection of fraudulent activity is key to minimizing the damage. Section 2. Tools for empowerment. Fortunately, you don't have to navigate the world of credit monitoring alone. Numerous tools and resources are available to empower you to stay informed about your credit standing and take control of your financial well-being. These tools range from free credit monitoring services to comprehensive credit monitoring and identity theft protection plans. One of the most accessible and valuable resources is annualcreditreport.com. This federally mandated website allows you to access your free credit reports from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once every 12 months. By staggering your requests throughout the year, you can essentially monitor your credit for free. Beyond free credit reports, various free and paid credit monitoring services can provide more frequent updates, alerts, and insights into your credit. Popular options include Credit Karma, Credit Sesame, and NerdWallet, which offer free credit scores and monitoring, along with personalized recommendations for improving your credit. For more robust protection, consider enrolling in a comprehensive credit monitoring and identity theft protection plan. These plans typically offer more frequent credit report updates from all 3 bureaus, real-time alerts for suspicious activity, and identity theft insurance that can help cover expenses associated with resolving identity theft. The best credit monitoring tool for you depends on your individual needs and budget. If you're primarily looking for basic monitoring and alerts, a free service might suffice. However, if you're seeking more comprehensive protection, including identity theft insurance, a paid plan might be a worthwhile investment. Section 1. Your credit, your future. In the intricate tapestry of personal finance, your credit score and report are threads that weave through every financial decision you make. Understanding how these elements work, how to improve them, and their impact on your financial health is essential for anyone seeking financial stability and growth. Remember, your credit score is a reflection of your financial responsibility, a report card that speaks volumes to lenders and other entities that rely on your credit history. By adopting responsible financial habits, paying your bills on time, keeping your credit utilization low, and being mindful of new credit applications, you can steadily build a strong credit profile. This, in turn, paves the way for lower interest rates on loans, better credit card offers, and greater financial flexibility. Monitoring your credit reports regularly empowers you to catch errors quickly and detect any potential fraud. Safeguarding your financial well-being, take control of your credit today and unlock a world of financial opportunities. Remember, a healthy credit score is a journey, not a destination. With consistent effort and smart financial choices, you can build a solid financial foundation for a brighter future. Please like, share, and subscribe for more videos like this. Thank you so much for watching.